Alright guys, this is Currents and this is the second lesson for the part 2 of the class. So in this lesson we're gonna talk about money management. This channel do not intend to replace any trading and coaching programs. It's a deep introduction of the world of crypto trading. The series of this channel must not be considered as financial advices. Our content are only here to educate, inform, and entertain. Trading can be very risky. Only risk money you can afford to lose. Now, I strongly recommend that you use the second workbook to follow the class or understand better, and use the link below to get it. Okay. So, swing trading money management can be resumed in just one sentence, which is go slow. Like I said, go slow and steady. It's not a quick money scam. It's something that happen over time. Now, some general principle about money management. First principle is never risk more than 2% of your tradable balance. This includes margin. And you need to understand the difference between laddering and point entries. And then from a swing trading perspective, it's I strongly recommend that you stay away from leverage that are over 5 times X, which means if you have a $10,000 capital, you can trade up to 50k. More. I don't think you need more margin than that. So I strongly recommend that you stay away from anything bigger than that. And other principle when it comes to money management, you need to set up and follow your trading plan, and then pay yourself based on your goal and trading age, which means how far are you in your trading journey. And all you need, honestly, especially in the cryptocurrency and in most market in which you're trading assets, all you need is 2 to 3 massive trades per day. So there's no need to be taking too much action in the market. Now, first principle, never risk more than 2% of your tradable balance. Now, you need to respect this rule for all your trade combined. You can go over 2% in some very specific trading strategies, but that is more for advanced traders. Now, you need to keep in mind that if you lose 50% of your account, you will need a 100% profit to recover, just to make it for you to understand. If you start with your account with 100 grand like that, and then you lose 50% of that capital, so you only have $50,000 left. Now, in order to recover, you need to double that money, which is literally 100% profit. So that's the reason why you need to make sure you understand how you expose yourself and your capital in the market. Now, for a long-term play, which is a little bit different, there's what they call a 60-40 exposition rule. So if we have a 100 grand, you should never expose yourself more than $60,000 of your trading capital. Now, that is by long-term play. I mean that if you open a position in some coin, and then you intend to, for example, you're gonna transfer that to a cold wallet and you're gonna save it for the long term. We're talking about 10 and more years. Now, you need to make sure you keep this exposition rule in mind. Now, difference about different way of entry. Now, laddering entry is when you take a position size that is you already plan to do it. Let's say that you're gonna take a 50k position size, and then you split it in like 3 different positions, 2 different orders. Like it can be 10 here, 20 here, and 30 here. Now a different price, and then that would be considered as a laddering entry. Now there's some pro and there's some con of using the laddering entry. It probably the best strategy, that is my personal opinion, when dealing with a very volatile market. Now crypto is a big one, okay, which is a little bit different for stocks. Really depends on what is it you're trading on stock, but most well-known companies that are traded, they tend to be very stable in their price overall. Now it gives the trader a better average entry price. By this I mean, if you're trading an asset, let's say that you're trading Ethereum, and then you have a laddering, you're trying to enter a position using a laddering entry. So you have $1,000 here, okay, $900 here, and $800 here. Then using that same strategy, then you put $10,000 here. Now if this order got filled, your position size is a $10,000 position size. Now if the market goes a little bit deeper, and then your second order of 20k have been triggered, then you have a $30,000 position with an average price that would be somewhere here. So you're gonna have like a $30,000 position somewhere here. Now if the market goes a little bit deeper and hit your third position, third order, then you're gonna have another order of 30 grand that have been filled, and then that will place your average price somewhere here with 60 grand. So it's using this makes it easier for you to be profitable. Now the strength of this strategy is also its weakness. Now the con is that losses tend to be bigger. Now as you can see, the more order you get filled, the bigger you get exposed in the market. Now if the trend reverse, then that can create a bigger loss. It can be deadly for reverse trading style, and this is something we're gonna have to talk, especially when we're gonna review RSI. Now laddering entry using moving average, that will be an example. So this is a set of 5 moving average. I think that's the 10, 20, that's the 50 and 100 and 200 moving average. Now a trader can try to ladder using those different moving average. Now if the market decide to go somewhere here, you're gonna get your first order filled. When the second is filled, your average price will be there, and then when your third got filled, your average price will fall somewhere here. The same things if we go a little bit deeper, and that will make it now if the trend persists, you're gonna be profitable with a very good average price. Then that will allow you to place a stop loss and move it up and to lock your gain. Another way to do it is to use laddering using Fibonacci retracement. There is a whole chapter about Fibonacci, so we're gonna cover that. It's a little bit the same principle. People tend to trade the 38% those level, and then some traders, include me, they place their stop loss on the 68 or literally here. So if the market go something like this, or even like this, if this is the scenario we get, then you get an order of 8 whatever asset that is. Now if those two orders got filled, your average bar is gonna fall somewhere here. Now if the market decide to retrace a little bit deeper, then you're gonna have an average price here, and eventually if you get a 100% retracement, which is a big sign of reversal, then you get out of the trade. Now as you can see, the deeper we get, okay, the more exposed we get. That makes the loss exponentially high. Another technique is to use enter time frame. Now if you are familiar, if you did go and watch the video about time frame, you know that every single one of these colors, they represent a time frame. Now this will be considered as a support resistance zone, a big one. The reason is you have a support and resistance line from different big time frame at the same range, like 720, 629. Then you can use that. For an example, that would be the monthly time frame here, and this is a daily, and you identify this zone at 2 different time frame. So the first time we make it to that zone, that kind of reaction we have here, that kind of reaction is expected. So that would be a quick scalp or that kind of stuff. Now in some trading strategy, you will learn to study this zone in order to enter a short position. Now point entry, there's some pro and there's some con. Now point entry is best in market with big market cap, so very high market cap. So X-Talk and I think 4x2, yeah, certainly. Now losses are extremely precise and risk ratio are clear. So when you're placing your orders, you know your risk. You know exactly your risk. Now the con is that it's not for people that are psychologically weak, not for weak personality traders. They tend to be radical on management. That would be an example here. Now you identify this downtrend line. Once it get violated, then you open a trade somewhere here at 428 here, and then it's one order, just one. So you know exactly where you're gonna take your loss, and you know exactly where you expect to take profit. Okay, so the loss is stable. I'll say stable. Okay, now a different one here is that you have this zone right there, probably a support or resistance zone, just like the way the one that I've shown you. And you have a first reaction here, you have a second reaction here. At that moment it's a potential zone. Then you have a third reaction that will be a confirmation. Now this will have be where you would have entered your trade. So this is a zone between 50 and 38, a single position with very good risk ratio. Stop loss you would have placed your stop loss somewhere here, and this zone would have be your first target. Now this is one position, that will be one position, and a clear loss if you have to take a loss. Now still in money management, need to pay yourself based on your goal and trading age. So if you are very new to this, we're talking less than 2 years, I always say the exact same thing. You cannot expect to make money every day and like making a living out of this. And some traders, including me, we can wait. We can take a full year of trade and take profit one. I mean, pay yourself once per year. So at every moment in your trading journey, you will ask yourself why you're doing this, and that will define how you take profit. If you're gonna make a living out of this, or if you have a job, or if you have a different source of income, so that will define how you take profit in the market, because you use money to make money, and withdrawal from your trading account literally, because you're gonna use the same analysis no matter what. If you have less capital, you can expect less profit too. So I assume, and you should too, that as a beginner, less than 2 years, you are not here as a full-time trader unless you have a stable income in some way. I don't know, whatever, because you cannot expect to be functionally profitable in less than 2 years unless you have a very good mentorship program in which you're not really trading on your own. Now, at different level, first of all, you're gonna be here. Less than 2 years, this is a proposition. For the first 2 years, what you can do in crypto, we are in crypto, okay? And I think you can do the same thing. When I was preparing this presentation, I don't think it was it was not allowed to have $500 in a stock account, but now it's possible. So I guess that applies to stock market. Now you gotta open a small account, trading account, under $500, sorry, and then forget about being profitable in the first 2 years. This is not what's the most important when you first start. What's the most important in the first part is to be focused on being consistently right in your trade 50% of the time. Now, third point, being able to stick to a point. You want to, when you complete your first 2 years, you need to build the discipline of sticking to a plan. You need to have your technical analysis skill on point, and not blow up your account are the only what you can expect. Now, if you manage to pass those 2 years, which I think it's gonna be very difficult, but not blowing up your account is supposed to be a goal, because that will be an achievement, especially in the first 2 years. Now, this is very controversial, but I always say that you should start trading on margin, and I don't recommend starting trading on paper trade. The reason is simple, because of the emotional element. When you are trading cash, when you are trading margin, and when you are paper trading, you literally think in 3 different ways. And margin is certainly the most profitable, the most potentially profitable, this is the one you need to master. There's no difference in the action you're gonna take in the market, whether you're trading cash or whether you're trading paper trading. It's the same analysis, it's the same action you're gonna take. So I recommend you start margin right away. Okay, get used to those actions, get used to it. So as soon as you truly understand how to place orders, the basic orders, stop limit, that kind of stuff, you need to go ahead and start margin right away. This is the most profitable trading form. This is the one you need to master. So in the first 2 years, this is your music, staying alive. Okay, now second thing is that you just complete your learning curve. You've been consistent in the market, consistent in technical analysis, watching chart every day, and I still do watch chart every day until now. And this is a proposition. for the year 2. So we have 0 to 2, and we have year 2, and then from 2 to 3, and then we have 2n plus. Now for year 2, after completing year 2, you need to focus on recover your loss. Since you have a trading plan, since you have been studying technical analysis, and then since you know since you've been using the most dangerous form of trading, which I recommend, margin trade. Okay, small account, $500, nothing more, just for learning purposes, and you need to start recover your loss. No matter how much money you lose from that $500, you should focus on that. Now at this point, you need to be clear about your trading style. So if you've been trading for 2 years and you've been learning it on your own, after 2 years, if they ask you, are you a trader, you need to be able to answer, yes, I am a scalper, or yes, I'm a day trader or swing trader, whatever. Your trading style must be clear in your mind at year 2. Your trading plan must be clear. Now, it's many traders, including me, we have different trading plan. We have been using them for years, so we have a set of 10 trading strategies, that kind of stuff. But I am clear on my trading plan, and I'm gonna show you how to build one. And you also, after the first 2 years, the point also, maybe trading is not for you, so you're gonna know that. Okay, so this is the music of year 2. All right, so after that, this is the moment when you're gonna be trading consistently, watching short, doing technical analysis every day, or studying other trader style. That's a good way to learn. And you made it to year 3 and plus, complete year 3 and plus. Now this is my proposition. This is where you need to define your how you're gonna reward yourself. How are you gonna pay yourself on a periodic way? Is it gonna be yearly? Is it gonna be quarterly, like every 4 months, that kind of stuff? So this is based on what have you decide about your trading style and why you're trading, and it's very personal finance. So second, 3 and plus, start teaching other people. Showing them the basics, buy, sell, and the basics. That's actually one of the best ways to be good at that stuff. And then deliver on your trade, which means practice what is it from the first 2 years. Stick to your plan, develop new strategies, and understand there are new strategies when you're developing new strategies. So this is your music for year number 3. Now, still talking about money management. During the entire process, you need to keep an open mind. Like I said, always be open for all, because what's gonna happen is that since most traders are not profitable, so since you start delivering good technical analysis, good trades, and you're part of communities, you're gonna find other traders with different style, with different way of interpreting their market, with different way of doing their analysis. Then you need to keep an open mind, because the market literally does whatever you want, and there's no real master in that stuff. So it's like iron sharpening iron. You teach me and I teach you too, and just that is the right mindset when you're a trader. Now, in order to consider your learning curve complete, because it's not just a question of year. Maybe you spent 2 years, but you've not been trading really consistently, or you have not been reading any books, or you've not been doing any technical analysis. Now, it's not just a question of year. one of those things, and more than one actually, one or more will happen to you. In order to consider your learning curve completed, you must fulfill at least one of these. You gotta read and understand a well-known technical analysis book. I might give you some references, but my books are what you can use for this tutorial. You need to complete a well-designed trading class or tutorial just to give you the foot on the field, so you can ask the proper question. Because if you know what you need to go and look for, you are most likely to get a decent result overall over time. Now, need to follow and learn successful traders. There is zero trader in the market that are trading alone. It's always a team, or just like I am part of many different communities, and so I know many traders and I know traders all over the world, and with technology now we can work together. So you need to be part of, network with other traders. That is very important. And you're probably gonna blow up your account and recover. That is probably one thing that happened to every great trader out there. All right, now the trading plan. This is big here. Your trading plan is the backbone of your trading. I need to correct that, but trading style. Your trading plan is the backbone of your trading style. Sorry about that. Okay. Now these are the elements right there. We're gonna go over them, talk about them. That must be part of any trading plan. You need to have a single trend sturdy condition. The keyword here is single. Now, your trend sturdy condition is a condition that will answer one question: what is the major trend? And from that, you can only answer three things. Are we bullish? Are we sideways? And are we bearish? And this happens 50 to 70% of the time. So you only have 50 to 30% of the trading time in the market that you're gonna have two different trends. So it's important that you have one condition that will tell you, am I gonna go long or am I gonna go short? You need to be clear on the trend. This is the first thing you must always be clear on every time you open your shorting services or your trading account. Don't take action before you are clear on the fact that we are in a bull market, or we are in a bear market, or we are in a sideways. Now, not more than 3 to 4 technical analysis indicator. I think I've already told you that. And all your tools must be ready. So you open your computer, or every time you decide to take to trade, we're gonna do technical analysis. Everything you need must be there. Headphone, the basic stuff. Now these 4 points in blue are there. This is where you act. I would say this is where you act. Okay, this is your, I would say there, this is where you study the sentiment. This is part of your trading plan. You need to know exactly how you're gonna enter your entry strategy that is directly related to the sentiment. Because for an example, I have a set of action that I take when we are in a bull market. I have a set of action that I take when I'm on bear or sideways. So when it comes to how you're gonna act after you're done with studying the trend or the sentiment, you need to know clearly what are your sets of action that define your entry strategy. And then if you do take action and enter, how do you gonna exit, because the way you enter might not be the way you exit. For an example, you can use a point entry to open a position and decide to close the position using laddering exit. Okay, so the third point, and probably the most important one, is you need to have a set condition or strategy that will clearly tell you it's time to just wait and stay away. You don't take action. This is where you do not order, because you're probably gonna keep doing technical analysis or any form of analysis, but you're not making orders. And in the market, honestly, most traders spend most of their time not taking any action. They are either already in a position or they are waiting to enter one, or if they are in a position, they are waiting to exit one. Now, this is the point in your trading plan that save your account. You need to have a non-negotiable taking loss condition. When this is there, you take the loss no matter what. You have and then here in your trading plan, that will be considered as money management part. A defined position size for your initial order. So for an example, I may say for the next 3 months, my first order will always be a $10,000 order. So the first one is never more than that and never less than that. So you need to define your leverage. So I say you don't go over 5 times. You can do 2 times, 3 and 5 and below. Now this is tracking or monitoring your action, trading journal, and then yearly overall performance. So as a swing trader, you're probably gonna have to take profit once a year, or maybe 2. So this is where you keep track on your performance, and this is all part of your trading plan. Now, trend study. So we're gonna go ahead and talk about a little bit more about trend study condition. Now, this must always be done on your trend study time frame, and I talk about trend study time frame in the trend study lecture, first part of the class. You already know, and like I said from part 1, that your trend study time frame is 6 to 7 times higher than your main time frame. So as swing trader, just quick reminder: 1 4 hour, and then 1 day, then 1 week, and then 1 month. These are mostly the time frame you're gonna use to do your trend study. You use those time frame to do your trend study. They are not the trend, they're just the one you use. And this one is like your main time frame can be a daily, and this is where you go and take action a little bit in depth when you have a setup or a pattern that you want to trade. Now, this is the first analysis you do every time you open your trading service account, every time you open your computer to trade or to do technical analysis. Your trading platform must be the last thing you open, if you are, because sometimes you do technical analysis in your trading account. If it's a professional, some offer good technical analysis tool. If you're a trading store, I know that Robinhood do not offer TA possibility to make good TA, so it really depends. But you're not taking trade without going through that. You must always be clear about the major trend, and I have to repeat that as much as possible because that's extremely important. Before you do anything else, always be clear about major trend, because that's gonna define the sets of action you're gonna have to take. Once you agree on a certain specific trend, you will prioritize some approaches more than others. Approaches that are more related to the major trend again in itself. So this will affect all trades related to that trend and the management of any open position. Now, technical analysis, indicators, and tool. Too much tool won't make you a better trader. And over time, most traders and experienced traders, they tend to use less tool. And by less tool, I mean in almost anything, not just technical analysis. You will find a beginner with like 6-7 screen on his computer. A good trader barely use more than 2, and most of them, they only use 2, and they're simple in almost anything. So the better you get at it, the less stuff you're gonna have on your chart. So, but you must experiment as much as tools as you can, because it is your responsibility to find the technical analysis tool that tells you the most about the market, and especially that tells you the most about what action you're gonna take regarding your trading strategy. By this I mean, find what works for you, and once you find it, you reduce to only what you mastered over time. Anybody who tells you something else is after your money. When it comes to trading style, when it comes to trading in general, if you are the one taking action, you gonna have to find what works for you. There's no such of thing of copying someone else's sets of tools or indicators, because if it doesn't make sense to you, it will never work. It's just the way it is. If you're using more than 4 indicators over time, that will be after 2 years, and if you use more than 3, you probably don't doing it wrong, and you probably need to learn more, and you need to adjust your capital, your exposition, the kind of money you make, you're putting at risk based on that too. Now, entry strategies. Now, once you are clear about the major trend, because we have to be clear about the major trend, you have your tools. There's a lot of technique to enter a trade. Every used technique must be mastered as much as possible, and this only comes from practice. Obviously, this is how you're gonna lose money if you're doing it wrong, and some people will tell you do paper trade. I don't recommend it, but if it works for you, like I said, you can try it. But I don't think there is enough emotional load, or emotional element in those when you're not trading real money. Now, the trend only decide when your entries are going to be buys, sell, stay away, but do not indicate how to buy, sell, or stay away. Trend tells you what to do, and not how to do it. Are very important here, because once you have a trend, a clear trend, sturdy condition, or you can say strategy, the trends will be clear. So you start here, but once you get your trend, it can be anything. Once you get it, you need to develop a set of strategies that will lead to decent entry. Decent entries. It doesn't matter if it's bullish or bear market, bull market, or sideways. Once you get the trend will redirect you to a set of strategies that will give you the best entry possible. And this, you master it over time, really. That like I said, this only comes with practice, and that's the reason why you need to do it with real money. Personally, that's what you should do. Now, exit strategies. The trend might influence the nature of your trade entry, but your exit are essentially psychology, because when you're about to put some money at risk, there's only two things that can happen. So when you take a trade, you take a risk, and there's only two things that can happen. You can become profitable, and you can take a loss. Now, really depends on how you enter the trade. Your loss, you know exactly how you can control your loss. Now, when it comes to profit, you can pre-select the target, but it's essentially psychology. It's a psychological decision, because taking a loss and keep a profitable trade are two trading psychology reality, if I can say it like that. So the goal in swing trading is to get the maximum profit possible from any open position that are profitable. Now, self-control is probably the most useful attitude once your money at risk. So anything can be a bad decision, including taking profit too early. Okay, now there are some conventional ways to look for target, but generally exit can be more dynamic, since if, like I said, if you're profitable, you're free to decide how much money, how much profit is enough for you. Now, stay away, big thing. Personally, staying away is my favorite trade, and I think this is probably the favorite trade of most experienced trader out there. It can represent anywhere between 70 to 80% of your trading time. So if you take if by this I mean if I invest 100 hours per month doing technical analysis plus trading activities, well, 80% of the time I'm just sitting there doing nothing. Because once you are you're sitting down in front of the computer, it's either you're waiting to enter or you are in a trade. So if you're waiting to enter, then you're still waiting, staying away. And if you are in a position, if the position is profitable, then once again you just stay away. There's nothing you can do. You just gotta wait and let the position give you as much profit it can give you. And if you're not profitable but you haven't hit your stop loss yet, but once again you just have to stay away. So 70 to 80% of your trading time you're gonna be staying away. If you're taking too much action, you're probably doing it wrong. So I guarantee you, if you force the market will soon show you who is the boss. And I suggest that you value this boring period by investing in yourself, reading, backtesting your technical analysis, and I should say teaching harder. Doesn't have to be anything very specialized. It can just do basics, friends and family, and trust me, that works a lot. Now, staying away will often be the best trade you ever take, and because staying away I've been many times the best trade I ever take. Now, trading plan. Now, your non-negotiable taking loss condition. The reason why I specify non-negotiable is because sometimes, especially beginners, when they have a stop loss, for an example, and the trade is moving against them, they, for an example, let's say that they buy something at $2 and they have a stop loss at $1.78. Their target, first profit target, is like $4, and then the price is moving down to $1.85, and then they're looking at that and they move their stop loss down to $1. Now that is a no. Once you set your stop loss, you stick to it no matter what. Even if you sit down in front of the market and you realize that the market is moving against you, you stick to it, because if you have to take it, a loss, you have to take it. And personally, the way I always tell people is that calling it a loss is not a good name. But what I say is that if you have an account with 100 grand in it, and most people lose because they hold on to losing trades, and by most, we're talking about 80% of losers in the market. So if 90% of people are losing money that way, that means moving your stop loss is probably what everybody's doing that makes them losing money in the market. The other thing you need to understand is that if you lose 10 grand out of this, and then you down to 90, okay, and then you have another trader out there, it just lost 10,000. I mean, yeah, 10,000. He did remove his stop loss. I mean, he moved it down to, like I said, to $1. Then you did take the loss. Now, generally, when the trend reverses, that means you were wrong in your trend strategy. Trends, they persist and they tend to last long. So if you were wrong about bullish and it's a bearish, you can just go ahead and use that 90 grand and enter another position in the direction of the trend, while the other trader is still holding to a loss. This can easily turn into a 50,000 loss, and then here a 40,000 profit just by taking a loss. So I don't like to call it taking a loss. I like to say it's you protecting your choice, because the next time you're gonna take a trade, if you are right with a lot of capital, then you're gonna make enough money. If you are right with after a big loss, then you're gonna have to be right more often. So that's the reason why. So personally, I find it not profitable to set stop loss based on percentage on the crypto market, since it's a very volatile market. I prefer stop loss based on price and zone of support and resistance, but that's a discussion we're gonna have to do in the third part of the class. Now, but taking loss can adequately consist of zone of violation. This is something that I'm gonna have to come back and talk about in real detail, but we can use percentage retracement, percentage of rally. Like I said, I prefer this in stock over crypto because of high volatility in crypto. Some people use moving average. For an example, I know traders that as soon as 100 is violated or 200 is violated, they take a loss. Last recent swing, if the trend was moving like this, for an example, and then they use the swings, they use those level as stop loss. Let's say that they did enter along here, and then the trend goes against them, then that would be their stop loss somewhere here. And some people use trend line too. For an example, if you have a trend, if you have this, and then you have a trend line, and then the market is moved, and then the moment the trend line is violated, if the stop loss was there, they go ahead and tighten their stop loss to protect to lock their gain. Now, these are a very dynamic trading strategy. The part 3 of the class is more about presenting you guys different advanced trading strategies that are well known and well documented in the market. So that's the reason why we're gonna have to talk about this in depth. But once the condition you have set to take a loss, once it's triggered, you need to get out, take the loss, and then move on. Now, in your trading plan, we're still talking about trading plan, which is part of money management. You need to define your position size. Like I said, I know every time I open an order, whether I'm laddering or point entries, I know exactly what size I'm gonna put first in. If it's a 10k first order, 5k, whatever, depends on your size in the market. So after way of doing this, there are many costs. Now you can set up a predefined account for one trade, 1 year trading period. For example, I know that some brokerage, if you're in stock like Fidelity, you can have many accounts. So if you have a big capital, I say 500 grand, you can move like 10, 50 grand here, and this is the one you're gonna trade the whole year. So that would be how you set your capital, the one you're gonna trade, and then in that you're gonna define your position size every time you have to open. The other way is to set up a predefined sets of trade, and we evaluate every set of trade. For an example, if you taking more action, if you trade more often, more than 5 tens, you can say, well, I'm gonna evaluate my position. If I used to take open orders of 10k, I take like 1, 2, 3, 4, 5 trade, and then I reevaluate. Maybe I'm gonna take orders of 11k and reevaluate again, and keep moving that way. Now 1 year period, just a little bit more insight about this. It is best when trading as a group. Now if you are trading as a group, you can define a position. Go ahead, define your how much capital you're gonna expose, and then you're gonna define your position size. Now you set up your account, for example, for a year, let's say $100,000, and then rules regarding the account are defined before opening. Access, rule, authorization. This is a little bit more administration thing, especially for an example, friends. If you're doing it like in friends and family, because what happens is that so often you have a friend or a family that even if you are essentially doing technical analysis, you have someone else who's into fundamental analysis, and you kind of help each other, and that can happen that you guys are trading in one account. That would be a good way to do it. You trade as much as possible for a year. You decide that is your predefined rule, if I can say it like that, and every trade position size depend on the entire account. So you all get together and you'll be like, well, this is what I find on my technical analysis. I think we have an opportunity to open a long, to open a short, and then you have someone else in the group and responsible of fundamental. If you guys are doing it together, then well, we back it up, and then we take that decision. We decide on the position size together, and then we make those decisions. That would be a proposition, decent one. The other one is best if you sets of trade. Let's say that you every 20 trades. If you have a more active trading style, because personally I trade very less. I barely trade 5 times. I barely open 5, but more than 5. I do lots of position management, but I barely open more than 5 positions a year. You evaluate and readjust the position size at every cycle of 20 trade, because after 20 trade you can have more money or maybe less. Maybe you have to keep exposing 10 grand at every position size. Maybe you're gonna have to reduce it to $9,000, or maybe you are very profitable in the first sets of 20 20 positions, then you have to start making orders of 15k. So how it goes is like you take a set of 20 first trade, they all 10k each, then open a position 10k, close, take profit or loss, open another position 10k, take profit or loss, another one on profit or loss until you make it to a set of 20 trade. Then once you make it to that set of 20 trade, you evaluate your entire performance. If you're profitable, maybe you're gonna go for another round of 20 trade of 15k, or if you did lose, maybe you're gonna go for another round of 20 trades of less than maybe 8k. So that's how you define your position size based on sets of trade, and that's all part of your trading plan. Now, a defined leverage if you're using margin. Now, I don't recommend that you move around with margin. If 2x, 2 times margin, that's what you can support, never change that. It's part of your trading plan. If it's 3, it's part of your trading plan, and more than 5 as a swing trader I don't recommend. So you pick one and you stick to it. It's not like, I just take a loss, I was using 2 times leverage, I just take a loss, I'm gonna maximize my leverage just to recover faster. Don't do that. Okay, if you have to use this leverage, stick to it. This one, stick to it. It's gonna make the calculation easier for you, and it's gonna make the emotional load of every position easier for you too. So never go over 5 time leverage. Like I said, for swing, the reason is that big time frames mean big move. Anything higher than 5 time is, I think, this is my opinion, for day traders and scalpers, because we're gonna go ahead and, especially in crypto, right? Especially in crypto. Okay, we're gonna go ahead and go to bed with our open position. So make sure that your calculation are on point. Example, you have $100,000, 100 grand on your account. You want to leverage 5 times, so 500 tradable balance. That's how much you can trade. And remember that 2% you can only risk as a first order. If you're laddering as a first order, you start here with 2% of that trading balance. Okay, now there's way to go higher than that. I often go higher than that, but this is for part 3 and very more advanced trading style. Now, trading journal, this is that part of the trading plan in which we monitor our performance. Performance. Now, this can be a notebook. I know many hold day traders or swing traders, they use a notebook, or they take notes. And another way is to use a trading view or any trading services that allows you to save notes and all your technical analysis. Some paid plan help you doing this. This is my favorite way to take note and monitor my trades, because I can record everything and go back and see what did work and keep track of all that. I do take note, but not that much anymore. Now, a yearly balance performance, you need to know over 12 months, but it can be 6 too. How much did you start with, and then how much you earn. So be reasonable on your level. Include tax on your calculation, because once you report your profit, you're gonna that will certainly influence your tax bracket. Depends on what country you are and what in what economy you are doing those activities. So if you after you complete your 2 years of learning curve and some 100% a year descent in crypto market, you can literally double anything every year. I think I said 2 years, but I'm more, because when I was doing this I was 2 years, but I think 3 years you can definitely expect 100% profit a year, and more, and you may adjust for the market, because other market mean that you're gonna have to go through another learning curve. You can only be profitable during your learning period if you have a good mentorship, and this is extremely important. Okay, this is extremely important. If you can find one trader that is very good, experienced trader, not just talking, show you a trader that show you his trade or her trade, and then you can go ahead and learn from him, from her, and then present your proposition of trade. Maybe she'll approve and he will approve and tell you what was wrong. This is the only way to expect to be profitable in less than 2 years, if you have good mentorship. Alright, so for the lesson 2, that's it. And once again, this is not intended to replace any trading coaching program. It's a deep introduction of the world of crypto trading / stock. The series of this channel must not be considered as financial advice. Our contents are only here to educate, inform, and entertain. Trading can be very risky. Only risk money you can afford to lose. So that's it, guys, and everything you're gonna need. Link to Discord channels, the books, and many other stuff that they're gonna be in the description of this video.